Bitcoin, the digital gold that promised freedom, wealth, and early retirements. One day your portfolio is skyrocketing, and the next, it's in free fall. If you've ever screamed, "I just lost everything," you know the brutal reality of crypto. Bitcoin isn't just an investment, it's a high-stakes roller coaster of volatility, hype, and market psychology. Millions of investors, from first-timers to seasoned traders, have faced moments of panic, watching their gains evaporate overnight. In 2026, the crypto world is more complex than ever, with AI trading tools, global regulations, and decentralized finance reshaping the game. Now, understanding why Bitcoin crashes and how to survive it is crucial. This video breaks down 7 key reasons Bitcoin can tank and how to protect you from total losses. Let's watch. 1. Volatility is Bitcoin's DNA. Bitcoin was never designed to be stable. Its price swings of 10 to 20% in a single day are normal, even expected. Unlike fiat currency, backed by governments and regulations, Bitcoin's value comes from supply, demand, market sentiment, and speculation. This volatility can create life-changing gains, but it also exposes investors to massive losses. Stories of people seeing their portfolios triple in a week, only to halve the next, are common. Emotional trading is a huge problem. Fear and greed drive decisions more than rational analysis. Even institutional investors struggle with volatility. ETFs, large-scale trading, and derivatives can exacerbate swings as they react to sudden price movements. Understanding that Bitcoin is not a stable asset is the first step to avoiding panic. 2. Market manipulation and whales. Bitcoin's decentralized nature makes it vulnerable to manipulation. Whales, individuals or organizations holding massive amounts of BTC, can move markets with single large transactions. A whale selling a portion of their holdings can trigger panic among smaller investors, causing cascading losses. Pump and dump schemes are another danger. Such coordinated efforts to inflate Bitcoin's price before selling can leave ordinary investors holding devalued coins. While regulators try to monitor exchanges, the global and pseudonymous nature of crypto makes enforcement difficult. Social media and hype play a huge role. Tweets from influencers, celebrities, or even Elon Musk have caused massive swings in the past. Investors who buy into hype rather than fundamentals are vulnerable. Bitcoin's wild swings aren't always about fundamentals. They're often about sentiment, coordination, and timing. SAN. Regulatory shifts and government actions. Bitcoin operates outside traditional banking systems, but governments still impact it. Regulatory announcements can trigger massive sell-offs or buying frenzies. For example, when China banned crypto mining and exchanges, Bitcoin plummeted. Conversely, positive regulations in the US or Europe have caused spikes. In 2026, governments are still figuring out how to handle crypto. Taxes, KYC, Know Your Customer rules, and central bank digital currencies all affect Bitcoin's liquidity and demand. Investors unaware of regulatory shifts often panic when policies change suddenly. Even small policy tweaks can have outsized effects. Exchange bans, mining restrictions, or sudden taxation rules can temporarily depress Bitcoin's price, catching many off guard. And those who fail to anticipate or adapt to regulatory environments may experience severe losses. 4. Security breaches and exchange failures. Bitcoin is only as safe as the platforms you use. Over the years, thousands of investors have lost millions to exchange hacks, phishing scams, and fraudulent wallets. Exchanges can go bankrupt, freeze funds, or vanish entirely. Even trusted platforms are not immune. And the decentralized nature of Bitcoin means that, unlike traditional banks, there's often no recourse. Personal security also matters. Weak passwords, unencrypted wallets, or careless private key management can lead to irreversible loss. Many investors say, "I just lost everything," after realizing their coins were stolen or their exchange collapsed. The lesson is clear. Secure your Bitcoin with hardware wallets, multi-signature accounts, and trusted exchanges. Regularly review security practices and avoid leaving significant amounts of BTC in online platforms. Security isn't optional, It's essential to protecting your wealth in crypto. 5. Emotional investing and FOMO. Fear of missing out, FOMO, is one of the most destructive forces in crypto. Seeing Bitcoin skyrocket, novice investors often buy at the peak, so only to watch prices crash shortly after. Emotional investing leads to panic selling during dips and greed-driven buying during surges. The crypto market never sleeps, and prices move rapidly. This constant pressure amplifies stress, especially for those who treat Bitcoin like a short-term gamble rather than a long-term investment. Learning to control emotions is crucial. Set clear entry and exit strategies, define investment limits, and stick to them. Diversify your portfolio to reduce exposure to dramatic swings. 6. No over-leveraging and margin trading. Many investors try to multiply gain using leverage or margin trading, borrowing money to buy more Bitcoin than they can afford. While this can amplify profits, it can also wipe out your portfolio instantly. A 10% drop in price could mean 50 to 100% losses if you're over-leveraged. Margin calls force you to sell at a loss, sometimes automatically, leaving nothing behind. Crypto exchanges aggressively promote leverage because it increases trading volume, but the risk is enormous. Even experienced traders fall victim. Market swings in Bitcoin are unpredictable, and overconfidence leads to catastrophic results. Those who say, "I just lost everything," often leverage their positions too heavily, ignoring risk management. 7. Market cycles and investor psychology. Bitcoin follows cyclical patterns: hype, boom, bubble, and crash. Understanding these cycles is key to surviving volatility. Historically, Bitcoin has experienced multiple bull runs, followed by sharp corrections. New investors caught at the peak often suffer heavy losses. Investor psychology drives these cycles. Herd mentality, overconfidence, and greed amplify price movements. When everyone rushes to buy, prices spike. When fear spreads, prices plummet. Awareness of cycles allows you to anticipate corrections and avoid panic decisions. Diversification and a long-term mindset reduce risk. Recognizing that crashes are part of Bitcoin's DNA helps investors ride out volatility instead of selling in fear. Understanding psychology, both yours and the markets, is as important as understanding charts. Lessons from the Bitcoin roller coaster. Losing money in Bitcoin is painful, but it's rarely random. Volatility, whales, regulatory shifts, exchange failures, emotional investing, leverage, and market cycles all contribute to losses. When approached wisely, Bitcoin remains a powerful, albeit risky, asset class. Learn the rules, respect the risks, and you can survive the roller coaster, maybe even profit from it. Let us know in the comments what you think about, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.